다시 돌아왔어요. 다시 끊겨서 다시 돌아왔어요. 다시 끊겨서 다시 돌아왔어요. 끊겨서 다시 다시 블룸버그 뉴스를 한번 볼까요? 자. 블룸버그 캐나다. 네. 블룸버그 캐나다. 블룸버그 좋습니다. 동영상. 캐나다 Fed. Thanks for watching CNBC. CNBC television. Tom Lee.
Can still track the market, so I'm less concerned about someone who wants Microsoft, Apple, Amazon, Netflix. But when you look at the sort of the big 12 stocks that were part of the work from home, those are extremely crowded trades. They really benefited from an elevated VIX and ultra low rates, and also the idea that people just weren't leaving their homes. As all those three conditions fade, you really want to rotate more into epicenter.
Tom, I have a question for you about Miley Cyrus.
에피센터를 좀 해야 되겠네. 안 되겠네.
What she did today, offered $1 million worth of stock to people to go into their Cash App accounts, which is a Square company, in promotion of her series. And it just speaks to obviously the rising popularity of retail trading and just the interest and the change in generation that is happening right now with stock ownership. My question is, does it signal a top in any way in this boom we've seen in retail trading, or does it signal that this is something that's here to stay and could provide a tailwind to the market?
Well, I mean, it's amazing. $1 million given to a lot of people is a great way to introduce people to stock ownership. So, I mean, it's pretty wonderful. And I think there is a future now, especially with crypto and blockchain and Robinhood and fractionalized shares, that people can use other ways to buy stocks. So I think it's actually quite innovative. I don't see it as a sign of a top, only because, our institutional investor clients remain pretty cautious. I mean, there's a lot of things that keep them worried at night. And if the institutions are nervous, and we know on Twitter, which I think is a good read on sort of the public, and we get a lot of bearish tweets, which I do welcome and invite. I think it's actually really helpful. I just don't think people are that bullish on stocks.
What's your view towards the small caps and the Russell 2000, Tom, which obviously did have quite a marked pullback towards the middle of last month?
Yeah, the Russell 2000 is a super important index in 2021. In other years, it may not have mattered as much, but because they're chock full of epicenter stocks, it's something we're paying a lot of attention to. There were some really critical levels in the Russell 2000, or IWM, that we were watching this week. One was a close above 220.93, because if that does take place, which it looks like it happened today and yesterday, it would be a continuation of what I think is a face ripper rally. You know, a rally that could take a lot of investors by surprise.
Shepard Smith here. Thanks for watching CNBC on YouTube.
Julian Emanuel's BTIG's Chief Equity and Derivative Strategist. Julian, good to see you.
Great to be with you, Melissa.
So are you saying this because you also believe, like the traders, that the 10-year yield is settled into a range at this point? Is that what we've become sort of dependent on in terms of forecasting the tech trade?
Well, it's been a big part of the story the entire year, for sure. And frankly, from our point of view, we have been more bearish on bonds in general than the street as a whole. Always ahead of consensus. Our year-end yield forecast is 2%. But if you look at it, and Tim pointed this out, is that we spent the last couple of weeks in a range. So we're going higher, we're grinding higher rather than shooting higher. And frankly, when you think about it, that's really a lot of the story of March. And I go back to the last time I was on your show at the beginning of March, and it was very, very frightening for a lot of people to hear us make the call that we thought select big cap tech could do well. But lo and behold, people are starting to focus once again on the idea that FANG in particular are secular earnings growers, where discount to the multiple doesn't need to be as punitive because you're not going to 2.5% or whatever in the 10-year yield imminently.
Should investors be focused at this point, Julian, on the possibility of a corporate tax increase, or is it too early?
No, it's not too early. And history is pretty conclusive about this, is that particularly when you raise both corporate and individual tax rates in the same year, stocks tend to underperform. And so when you
원래 이렇게 한쪽씩 해서 워밍업 했어야 되는데 아까 덤벨로 첫 세트에서 하는데 팔꿈치 좀 느낌이 왔었어. 그래서 여러분 본인한테 맞는 루틴이 있으면 그거를 해야 되는데 제가 오늘 첫 번째로 제 원칙을 지키지 않았어요.
Hey Julian, Bob here, and early happy Easter to you. Thanks for joining. So you mentioned that healthcare might be an area of
원래 이거를 먼저 했었어야
and I
되는데
think this whole pandemic situation really highlighted both the pros and cons of our current healthcare system. Would you mind drilling down a little bit and letting us know what pockets of healthcare you think have upside?
Well, yeah, and so if you think about it, healthcare has been a very sort of strange sector to think about because it's neither the value trade per se, nor is it the growth trade. And when you think about it in those terms, the nexus is the fact that healthcare as a sector is intertwined with government oversight and government regulation to a very large degree. But the fact is that we're coming into an environment where the economy is going to open up again. Things are going to normalize. You're going to have people starting to go to elective procedures more than has been the case for the last 2 years. There's certainly pent-up demand there. As well, this new telehealth type environment is not likely to go away anytime soon either. So we think there's really a number of areas, including if we consider that the rate of change of the 10-year yield isn't going to be too onerous, large cap pharma, which tends to be the yield play, but given what we've seen in the last year, is likely has elements of a growth play as well.
Hey Julian, we had a meme, as guy likes to put it on this show recently, where we had a dog and we had the dollar and we had tail dog. So as it relates to yields and as it relates to the market, your view on the dollar. We've had a bounce. Is that off oversold levels, or is that a dollar that's reasserting itself? Because that has huge implications for multiple asset classes.
And it definitely does, Tim. What we would say there is, if you think about the dollar rally, the commodity markets tend to work together. And the fact that the commodity markets haven't really come off materially in the wake of the dollar strength tells us it's really much more of a sort of position correction, oversold down, that we think ultimately ultimately, particularly as the plans for President Biden's next round of infrastructure spend come more into focus, that the dollar downtrend will reassert itself.
Julian, I wanted to circle back to the selective FANG names that you like. In theory, there are 5 names in FANG, so selective amongst this list is only a handful of names at this point. Can you walk us through how you're thinking about it as a percentage off of their highs? Because all of them are double-digit percentages off their highs of this value. Is it multiple? Is it the degree to which their multiples have compressed? How do you think about which FANG names?
So when we originally came up with this concept at the beginning of March, our view was the peak of value versus growth essentially was the beginning of September. And what we saw is the broader market was up substantially since then, but there was a range of names, and actually some of the largest semi names, which you talked about earlier in the show, are included there as well, is that they were down sort of double digits in that time. At the same time, the expectation is for double-digit earning growth over the course of 2021. We weren't really too concerned about the actual multiple at the time, because by and large, even though you can always say that these names are expensive, they're not expensive relative to where they were, and they're not expensive relative to the point in time that a lot of people fixate on as being the risk point in time, that being late 1999, 2000. You think of it in those terms.
Okay, Julian, good to see you. Thank you.
Thank you.
Julian Emanuel of BTIG. He likes healthcare. Karen, you like healthcare too.
Yes, I'm very in sync with Julian. I don't know that I've felt this in sync with him ever, but, I like FANGs and I do like healthcare. I think a lot of what he said makes sense to me, and I know we'll talk a little bit more about it later, but I think, I don't normally like things for a dividend yield, but the PEs are really low and the dividends are high, and it's not like the dividends are high because people are afraid they're gonna get cut. They're legitimate dividends, so I like this space.
I feel like Julian might
I've increased my exposure a lot.
and we'll talk about that more a little bit later. I feel like Julian might be blushing out there with how insane Karen is with him. Guy, in terms of FANG names, which FANG names selectively would you like here?
Facebook, it pains me. You can see my face.
Every time you say that.
Pains me to say it. Facebook is, listen, it's right there now, right around the all-time high. And by the way, I don't know what the difference between a meme and a GIF is, but a lot of people are sending them vis-a-vis Twitter about cats. Loosen up, folks. It was a joke, number one. And you mentioned NSYNC. I know for a fact that Justin Timberlake is a huge fan of the show, and he's probably one right now as well, along with Julian.
I'm sure.
Shepard Smith here. Thanks for watching CNBC on YouTube.
Do you stick with the playbook from Q1 or do you change?
Oh, good to see you, Melissa. I think you adapt. I mean, you must remain overweight some of the cyclical groups, and consumer discretionary is the biggest overweight, along with industrials. But I think you balance that with an overweight to technology, or at least a market weight to technology. We have been, sort of pounding the table during the first quarter that this trade is not over. The market, in my view, is reacting to more robust growth rather than interest rates. We could have that debate. It doesn't really matter. The stocks were down. And we see some names that have done nothing for 6 months, like a Microsoft, that will probably be a good bet for the next 12 to 18 months.
Yeah, Nancy brings up a good point, Jerry, in terms of the number of big cap tech stocks that have basically gone sideways for 6 months. I mean, it is shocking, but the names are the biggest in the world, effectively. Do you see some opportunities there, especially as being the real estate trade seems to be so tempting as we ourselves, as we get back to our normal lives, it's tempting to just say, you know what, the pandemic is over. Let's switch gears here.
Yeah, I mean, we have to acknowledge where we are, right? The primary thing is professional money managers like us are really torn right now because we have these great leaders that have pulled back or gone nowhere for them, and we're wondering whether it really is time to jump in the water and this. And I would argue too that number one, those tech names, while they're probably going to continue to be sources of funds, they've probably seen the worst of that, and it's more going to be a function of who can continue to execute and show Microsoft's case very solid upward momentum. But the other side of this is to just look at the names that you can find that have a cyclical play, but don't necessarily have to be all in tech, all in thematic momentum. And we have lots of ideas for that.
And we want to get to them, but I do want to ask Nancy one more question in terms of being in the cyclical trade and this sort of balance between wanting to be in that trade and recognizing that that is where the growth is, but seeing that there are opportunities. If you take a pair, and I'm just going to pick these two stocks, a General Electric and a Netflix, Nancy. Interestingly, right at this moment in time, they're at the same exact forward PE of 54. So at this juncture, how do you start to look at these sorts of stocks where you have GE with this massive run here today, and you have Netflix too?
Yeah, that's the conundrum. I do think that in the case of GE, they are in the sweet spot of many of the areas that may benefit from infrastructure. But for my bet long term, we don't own either. So that's my disclaimer. But I would be more inclined to look for opportunities to enter names like Netflix that will continue to just put up growth. And that's really what I think is going to reward stocks in the next 2 to 3 years. We're participating in this value trade. I think it's a trade. I think it's more of a cyclical movement than a secular trend. And so that's why we're barbelling our portfolios, because we think that's what you have to do. And it's worked very well in the first quarter.
Smith here. Thanks for watching CNBC on YouTube.
Initiating Uber this morning with a buy at a $75 price target. The stock also among their top reopening plays. Brent Thill is a senior tech analyst at Jefferies and joins us now. Brent, explain this to me. Uber has made this massive pivot over the pandemic to food delivery. Food delivery is not expected to show the kinds of numbers that we've seen over the last year. Ride sharing, yes, but it's transitioned away from that. So why is Uber more compelling than, say, Lyft that focuses solely on mobility?
Yeah, I think Uber is a platform. It's a global play. Lyft is largely one trick in the U.S. and in Canada. And what we like about Uber is the diversity. We like both stories. The U.S. is opening quicker given the pandemic as clearing international markets. We're still a little bit of a hangover in some of those markets in Europe. So that will drag on Uber. But ultimately, we think that both will benefit. Lyft in the U.S. opening and then Uber as it relates to the global opening. So our perspective long term is that the platform capabilities of Uber around free, mobility, food, long-term call options on air, and autonomous in their investments, that we think that they have more engines for growth and have more economies of scale. And as they say, technology platforms win and point solutions die. We think that they're in a great position to weather this coming out of this pandemic.
Brent, it's a great note. You say that delivery was a great hedge as rides were plummeting during the pandemic, but you still say delivery will double by fiscal 22. Why should it not be an offset if rides come back?
Well, I think it's going to be an offset. I think the way that we're running our lives now is going to change. The work from anywhere tries to continue. Again, I think the usage in my family is 4x in terms of food delivery. And ultimately, I think we are going to go back to rides. I took the first Uber ride in a year, just last week. So I think ultimately, as we believe there's kind of 3 avenues that you can play. Travel's going to open, dating's going to open, and that's going to lead to more rides. So we like, travel space, what's happening as it relates to Airbnb and booking in travel, dating, match and bubble. And as those things continue to blossom, you're going to need rides. So Lyft and Uber will be in that
lot of people thought it would be 2 years ago at the IPO, but as you point out in the note, it has shed autonomous, it shed scooters and bikes, it shed flying taxis, a lot of these big ideas that people were talking about for future growth. So given that, given the competition it has from the likes of DoorDash when it comes to food delivery, why does it deserve to be a $100 billion plus market cap?
Well, right now the stock's under 5 times forward revenue. We think you can get to 6.5 times. These aren't big multiples. And there are call options in all these other businesses. They didn't necessarily totally get out. They have call options, investments through partnerships in these initiatives. So I think they did the right thing. They've been experimenting. They've effectively come back to what the core of the business is. How do we get to profitability by Q4? And then they have these call options that are set in these investments in autonomous, in aviation, in other sectors that if they come to fruition, that they can participate. So ultimately, again, in the U.S., DoorDash is no doubt a major competitor. Their market share is almost 2x that of Uber. If you go global, Uber is the dominant global leader. And we, again, believe that their network effect, there's a lot of power as it relates to the other products they can bring into the mix as autonomous comes on, as we get the George Jets and flying taxi at some point. Will happen, but they have that call option in. I think the good news is this company's trying to innovate. That's the good news.
Shepard Smith here. Thanks for watching CNBC on YouTube. Dr. J, there he is. Good to see you, Doc. Unusual.
Good to be with you, Scott. Well, I know what you're looking for, Scott. I know you're looking for some unusual activity instead of unusual that I'm on just the phone.
That's right.
This time it's Qualcomm. Qualcomm, they're buying the next week out 140 calls, Scott. That's with the stock right here at like 135.70 or so. 1 week out, they bought 10,000 of these calls very quickly. Now you see the volume moving up towards 12,000 of them. That's an awful lot. I love the upside for this stock. I want these at the money calls, Scott. Sold some out of the money calls against it. Second trade, take a look at what's going on in Angie's list. That's what it used to be called. Now it's just Angie, A-N-G-I, but it's a $6 billion company. And they're doing a lot of things right, apparently. I know Loop Capital has some upside on them to 15 or 18 bucks, something like that. And we see big upside call buying for regular April, not the April's, but I'm sorry, May 15s, even longer. You got the May 15s out there, Scott. I want those calls that are more or less the at the money. And I'm looking for a lot of upside out of this one as people get contractors and look for them on Angie's list. I think that's going to be great for AMGI.
All right, good. Former Jim, real quick to you. Looking at my screen because I did a tweet on Qualcomm earlier. I know you obviously like John's pick. The tweet says, I followed Jim into QCOM, that's Qualcomm, getting killed here. What to do?
Getting killed? Oh, come on.
That's what they say, Jim.
Seriously, if you can't take...
That's what they say.
I hear you, and I don't listen. I never want anybody, I'm not going to minimize anybody's losses, but for goodness sakes, don't sell. You don't understand with a stock that grew 50% over the next 12 months. It might go down 15% from a high set a couple of months ago. That itself was up 100% over 18 months. So listen, with the reward of good returns, you got to take the volatility. Not minimizing your losses, but for goodness sake, stick with it.
Okay.
our FCC Chairman, Tom Wheeler, and Finucane of Bank of America, emerging markets investor Mark Mobius.
The bond buyers are looking for yield, and they're not going to find it in the U.S., so what they do is they go abroad.
And Peter Curtis of Aperture Investors.
We can't have negative yields in a period of prosperity, growth, government stimulus, fiscal stimulus.
I'm from the government, and I'm here to help you. Well, that used to be a sort of sarcastic joke. But this week, Global Wall Street got a taste of just how much the government is intertwined with our markets and with our businesses. Fed Chair Jay Powell and Treasury Secretary Janet Yellen reassuring markets they'll continue to be there for them.
We'll continue to provide the economy the support that it needs.
We should be clear-eyed that that's the hole we're digging out of.
To big tech company CEOs being taken to the woodshed once again by Congress. To state governments deciding day to day how open their economies will be.
I think you're going to see the capacity increase and the testing requirements decrease as we get more evidence. But we want to start safe and smart.
And it's not just in the United States. Politics and government dominate the discussion about where the economy is headed, with European growth being held hostage to a vaccination campaign that lags the United States, and the European Union at loggerheads with Great Britain over vaccine exports.
This is about making sure that companies deliver on their commitments to the member states and the European Union.
So it's no surprise that the markets this week basically paid attention to the Fed and prospects for more spending, with or without taxes, and
All right, welcome back, everybody. Right now it's time for the Executive Edge. I spoke to Microsoft founder Bill Gates and former Treasury Secretary Hank Paulson yesterday at a virtual event for the Economic Club of New York that focused on the environment and climate change. They are both optimistic about what they think they can do towards climate change, but they did say that this is an incredibly difficult problem to try and tackle. Bill Gates addressed the grid here in the United States and the regulatory challenges that are slowing the pace of innovation.
So there's days when I see the innovation, the piece of innovation, I feel, wow, we can do this. Then there's days when we look at like how easy it is to get transmission permitted in the U.S. and how that's just a conundrum that you know, has to plan for. You know, so every day there's data points that make me optimistic and some that make me go, wow. Most of these projects, even when they make sense economically, they fail to get all the approvals. You know, for example, there's a controversy in New England now about bringing down hydropower from Canada that would reduce emissions, and so the natural gas industry is in there lobbying against it, and you know, getting people to say, oh, anything that disturbs anything is you know, we just shouldn't allow it, and so the amount when you model out what the electric grid for North America looks like when it's providing a huge additional amount of electricity because that's replacing natural gas and gasoline. You have to see unbelievable transmission, say from the Midwest out to the East Coast, to bring all that wind and solar into where the
아까 시작했습니다, 박정희님.
needed. And you know, even if we go at full speed without these permitting.
알람 설정을 해놓으세요. 제가 하는 그 유튜브 알람 설정을. 캐나다 인터넷 상태가 별로라 어쩔 때 꺼져요.
To getting that to move forward. So, and the U.S. is not the only place that finds that a challenging problem.
he said he blamed it on the hydrocarbon industry. The natural gas industry is pushing back. There's 45 different groups that don't want that to happen. Most of them environmental.
Most of them are natural, yeah. Habitat.
Not natural gas and
That's the problem, not in my
That's a
backyard.
strange bedfellows. Strange bedfellows.
Yeah.
Environmental groups as well as the natural gas. But yeah, they.
Yeah, he just touched on that in another part, not in that soundbite you just heard, but he did touch on that in another part, that, yeah, it doesn't matter what the NIMBY effect, there are gonna be all kinds of people who don't want these things to happen. So it's not just federal regulation that you're up against, it's state regulation, it's local municipalities. But it is one of the big stumbling blocks, and like you said, you'd have to be building all of these things right now if you actually wanted to reach those goals that you've stated for 2035. You know, Hank Paulson is now running a fund that's focused on climate solutions, PPG. And the former secretary, actually the former Treasury Secretary, talked about the interactions that he has right now on a daily basis with CEOs who are talking about lowering carbon emissions.
You had 2,000 major companies, the CEOs have made net zero pledges. And so I started calling CEOs. I've been calling CEOs every day now for a couple months. And there's been an amazing change because a few years ago, they always said climate was important, but it was some cases lip service, and what they were doing, you know, a lot of it was delegated to sustainability officers. Now, they see that markets are moving and that there's going to be massive change. And, you know, when they look at, for instance, Tesla trading at 8 times the market value of General Motors, some of that may be a bubble, but this is also reminiscent of what we saw, you know, back in the days of cellular. You know, the markets look to the future. So the market value went to the future.
Taking the mound for tonight's pitch, Delano Saporu of the U Street Advisors Group. So Delano, go get him. What's your pitch?
Thanks, Melissa. My pitch today is Shopify. There's a few reasons why I like Shopify. If you're looking at the total addressable market, which is one of the big tailwinds for this company, you're seeing that increasing. There was actually a stat that stated that there was a 4.4 million increase in new business and entrepreneurs created over the past year, which is actually, it's a trend that we're going to see over time. It's not just pandemic with lots of jobs. It's actually way easier and less expensive to start businesses now. And if you're actually looking at what other areas of actual increase for this company, you're looking at the valuation. So think about stretch valuation. You know, it's very stretched. You're looking at price earnings trade over 400 times. But to actually look at the top line, what growth investors are going to focus on. They're growing rapidly at the top line, and this is something that I think is going to increase again over time. And finally, I know management's really focused on making great products for their users, right? They're looking into investing into these products and capabilities that users are going to be using going forward. So this is why I like Shopify, hoping to hit a home run on this one.
Guy, you had a question for Delano?
Yeah, I'm with you. I do. I mean, my question is right around valuation. I mean, at a certain point, valuation matters. I understand that, you know, in a low interest rate environment, maybe not so much, but as rates have moved higher, is that at all consideration? Does this valuation concern you if rates continue to move up?
Yeah, that's a great question, guy. And I think it's the past couple of months, right? So we've gotten to a place where it's been battered. The valuation is definitely going to still be concerned. Rates are going to still move up over the short term. I think we'll level off, you know, over the long term. I think that's a good opportunity. We're seeing Q3, Q4 for the growth trade, the growth rotation to come back into play. That's definitely a concern for short-term investors.
All right, Delano, thanks for that. No more questions. Time to vote. Are you buying Delano's pitch on Shopify? Guy, what do you say?
Can you read my smart board, please? I'm not sure if you're able to do that, Melissa.
Harley Finkelstein, #genius.
Let's Go Mets sign it. There's a baseball that says buy. I'm buying Toronto's pitch here. I mean, ultimately, with Shopify, you're not buying on valuation. You're buying on the e-commerce trends that affect a lot of companies in their space, of which they're right in the middle of. And in fact, their GMV of e-commerce is still low enough that I think you're excited by that and the consolidation. And I think a lot of it will be theirs.
Bonaway, it looks like you're putting a touch of the board. How do you vote?
I am. So I'm buying not yet. So I get in some here, and then I look to add to my position on a pullback.
Okay. Karen, what do you say?
Well, not shocking, I have to count. He's a great player, and, he's less than I voted here. I wouldn't have voted for the last $1,000, but just my DNA doesn't allow me to buy, 400 times earnings. Even though they're growing nicely, I think it's projected. 400 is optimistic, so I'm going to pass. I certainly wouldn't short.
Well, 3 out of 4 ain't bad, Delano. We'll see we'll see how the viewers out there vote. The traders have spoken. So you out there, get on your phones, find Delano's fast pitch on Shopify. Be sure to vote in our poll. CNBC Fast Money will bring you the results later in the show.
Watching CNBC on YouTube.
I think in a post-COVID world, we had an unlimited credit card of government spending to make sure that we dealt with the pandemic. We've done $5 trillion of stimulus, and we haven't paid for anything. Now we're at a turning point here. We put forward a new spending plan yesterday, and it's going to have a lot of spinach. And so the way that I like to talk about it is, we were doing a lot of candy, no spinach. Now we're getting some candy, and we're starting to get some real spinach here with these tax increases. So we have to say to ourselves, what is the net effect of not just this plan, but there's another one coming on April 12th or April 19th. That's going to be another series of spending and tax increases. What does that mean for the U.S. economy moving forward? And I would argue that we're going to see more tax increases than government spending based on that plan that we saw yesterday. The infrastructure spending the Secretary was just talking about has a very long lag time to be spent. It takes years for that money to come out. We learned that with Obama in 2009, but that's really been true for the last 50 or 60 years in the United States. And the tax increases are immediate. And some of these tax increases, while they may look manageable, you're talking about $1 trillion of U.S. multinational foreign income. You're talking about almost $2 trillion of tax increases over 15 years. And that's going to impact earnings per share on S&P 500 companies. That's going to impact competitiveness. And overall, I think it's going to be a net drag to the U.S. economy, both in 2022 and 2023, all else being equal. Now, there could be a situation where members of Congress delay some of those tax increases from coming into effect because they're worried about those tax increases in the election year. But even if those tax increases don't come into effect, we're probably still going to see a fiscal drag. $3 trillion of stimulus this year, and that's going to be very hard to replace next year. And when we look at the actual spending, where is that spending focused? Well, $150 billion highways of the $2 trillion. That's traditional infrastructure in Washington. And there may be some good reasons to do grid modernization and have a utility CapEx cycle, which is probably going to come and benefit industrial stocks. I do think that there's going to be a continued push for renewable energy. We're talking about almost $200 billion for charging stations of EVs. This is going to have an impact, and it's going to benefit the companies that are in that area. But there will be fewer companies that get that money than companies that get tax increases. And overall, this is going to be a net drag to the U.S. economy, at least in the short run.
In the short run, that's the question, because that's not the way it's being
Exactly.
sold. So for how long, how many years will it be a drag before it starts paying off, if it ever does?
You know, we'll know more once we see the Biden budget, the way they lay that spending out. But rule of thumb, Joe, is that for every dollar allocated on infrastructure, only 20% come out the first year. So they're arguing that they want to do about, I don't know, 200 billion per year in infrastructure, somewhere in that range. And so you take 20% of that, that means you get about 40 billion in the first year. You'll get 80 billion in the second year. So it takes a couple of years for it to really ramp up and get to the level that's actually being. The reason that happens is you got to plan, you got to get permits, you got to do the site designs, the architecture. All that stuff takes a lot of time. And by the way, it may increase productivity over long periods of time. But don't think that you're going to see this money immediately in 2022 and even in 2020.
I don't know if we have time to go into your calculation of the taxes on corporate income and what it goes up to, but that's a disturbing number, 62.7 on OECD, and that can't help, can it?
No, it doesn't help at all. I mean, well, look, it's one thing to say, okay, we're going to raise the rate to 28%, but you're also raising the dividend rate to 40%. And so that means the effective tax rate on profit is almost 70%. It makes the U.S. totally uncompetitive.
Shepard Smith here. Thanks for watching CNBC on YouTube.
We're just talking to Tom Friedman about that. I think one of the things he wants us to do is make sure that we spend this as effectively and efficiently as we can, because that's the environment that we're in right now. So just a couple of ideas in terms of the grid and trying to improve it. One of the initiatives, and I'm sure you had something to do with it, is to decarbonize the grid by 2035, which means you're going to need a lot of clean energy loaded onto the grid, which the journal points out, 20 gigawatts of high-capacity power lines need to be built between California and Texas. And that's a similar initiative was blocked by environmentalists from Canada to the Northeast for hydropower. Is there going to be an issue trying to, the same people that want to go green, there's a lot of regulations and trying to actually affect it. How will you handle that?
Well, first of all, you're right about the regulation. There is a huge patchwork across the country about how you get grid transmission sited to begin with, because it shares responsibility between state, locals, there's a lot of not my backyardism, etc. Honestly, we need to add capacity to the grid, we need to make it more resilient, and we need to make it cyber attack proof. We need to make it secure. We need the investment in the transmission grid for a whole variety of reasons, including that there are increased climate events that are not in power out more repeatedly. We say $70 billion a year just in the cost of the power outages alone. So we need a better grid, and we're going to do what we need to do to incentivize coordination to ensure we can get the siting. And now, if we get this through the Congress, we will have the means to be able to bring our grid up to speed for both capacity and for resilience.
Madam Secretary, I'm wondering whether where were you on easing the National Environmental Policy Act reviews? Did you argue to do that? It's been highlighted again and again how difficult, costly, and how long it takes for these reviews to try and get anything done. And Democrats refuse to allow that. And I mean, are you okay with how cumbersome it is to these Didn't you argue maybe they
I hate the bureaucracy. I hate it. No. That's when the government is nimble, the government is flexible, the government is efficient, the government is quick. And that's true all the way through. So I think we need to do, and we are doing internally, sort of a value stream mapping process. Where are the areas of redundancy? What is taking on long? Can we collapse permitting times? Can we have reciprocity? So yeah, we need to speed things up. And that's part of what can be incentivized, both at the state and local level as well as the federal level, to
electric vehicles. At this point, they're not as economically, it's not as easy to run one as it is to do the existing
I
structure
know,
that we
man,
have.
you obviously do not have an EV. I have had an electric vehicle now for 6 years. Now, I lease it, and I lease solar panels on my roof. And it is, I drive a Chevy Volt. It is the best car I've ever had. Right?
It still needs subsidies from the government to make it economically
Well,
feasible.
here's what I would say on this. This is a great question because of the investments we've made in research and development, the Department of Energy oversees 17 national labs, and a lot of them are working on bringing down costs, right? And the private sector obviously teamed on this. The cost of the battery, which is the biggest expense in an electric vehicle, has dropped 90% since 2010, and it's going to continue to drop. So you're going to see a point where the actual upfront cost of the electric vehicle is the same price as a traditional vehicle. You're seeing it now, and you're seeing obviously much lower entrance into the market. It's what GM, it's what Ford, it's what Tesla is working on. And on top of that, the savings that you have from plugging in versus gassing up is enormous. It's $600 a year for your average citizen. So it is a much better alternative, and people will start to see that more and more. You're right in that the uptake hasn't been as great because the infrastructure across the country hasn't been there, and that's part of what this American Jobs Plan is seeking to resolve.
Thanks for watching CNBC on YouTube.
Yeah, I mean, it's as Mike said, the March manufacturing ISM, the best in 38 years, and then the surface is new orders and production best level since 2004. A backlog also very, very nice. So manufacturing is absolutely humming. You actually don't need an infrastructure bill, I don't think. So my point is, if you add infrastructure on top of the great data that we're getting, you're going to really see us almost like a super cycle in industrials, in manufacturing, in commodities. And I think that's really why we want to have exposure. I think these stocks, industrials, for example, have outperformed the technology sector. Industrials are up 11% on the year. Energy is up 33%. Financials are 16%, and tech is up 3.75%. So is it a little bit of mean reversion today and yesterday? Certainly. They came down really far, really fast. You want to have exposure to technology, but you also want to have exposure to some of the parts of the economy that are really going to benefit as we get more and more stimulus into the system, and we see a little more inflation, a little higher interest rates. By the way, Caterpillar there's a rumor out there that Caterpillar is going to raise pricing across the board. That's also a very powerful theme for the industrial sector and for the cyclical sector. There's been all kinds of supply chain disruptions, and on top of that, you have better demand. And so you're going to see pricing power in these sectors, in my opinion. Yeah, for consumer stocks as well. Micron shares are rallying today after an earnings beat and a bullish outlook. Let's hit that name with Josh Lipton and some details. Josh.
Sarah, Micron beating expectations, really seeing strength across the board here from data center to automotive. Analysts noting that demand is now outpacing supply in the DRAM market. That's driving improving pricing trends, they say. Stock rallying 130% over the past year. Separately, the Journal is reporting that Micron and Western Digital are exploring a potential deal for Kioxia for $30 billion. That's the Japanese chip company. SMH, by the way, now up more than 15% this year, closing out 6 straight months of gains yesterday. Back to you all.
Josh Lipton, Josh, thank you. It looks like it is the strongest S&P industry group right now in the market, up 3%. Steph, how does Micron look, and some of the other semi names as well? Caught in the crosshairs of this whole supply chain issue, shortage. We know the White House is pretty focused on it and is having a meeting on it as well. Within technology, I'm very overweight semis and semi-cap equipment for this exact reason. Micron's numbers were outstanding. They talked about tightness in the DRAM. Demand hasn't even really started to see an improvement, and that's coming in the second half of the year. I own Lam Research. I own NXPI. I own Qualcomm. The bigger news to me was TSMC putting in $100 billion to expand capacity over the next 3 years. This is on top of $28 billion that they're going to put in this year alone, and on top of Intel's $20 billion plan in terms of expansion. shortages in supply. We know the auto industry, for example, they are going to lose $60 billion because of the shortages of supply this year alone. So they've got to get that going. I thought the CEO's comments from TSMC was very interesting in terms of them being over 100% utilization rates. So it's going to take time, but these are why you want to own some of these other supply chain names based off this news.
Shepard Smith here. Thanks for watching CNBC on YouTube. Not to go after some of those infrastructure stocks at this point. Did I hear you correctly?
Well, I said that if you're really going to play that game, and it is a game, be aware that it's been a bugs game for many years. So own stuff that can, on its own volition, do well. Nucor's putting through price increases. They've got demand for every of their steel, so I'm cool with that. Same thing with Martin Marietta Materials. They are only in growth areas of the country, and that is one that you want to buy if you believe in it, because they'll do well away from that. So what I'm trying to do is make it so that there's kind of a fail-safe, because we have historically been really bad at the so-called shovel-ready projects, bridge and tunnel. That's just not what we're good at. At one point, we were a great country about that, but let's just own that is not our strength anymore. So I'm reluctant to play that particular group of stocks. I know, and I defer because I do spend a lot of time talking to Steph because we have many, many years, but I saw URI down 4 today after reversing. I said, well, okay, listen, if you really ought to be there, then go with United Red. And by the way, can I just say we are at a halcyon moment for this today? I do think it derails tightening, but Gary Dickerson is running a lot of years. He is fantastic. Tim Archer running Lamb Research. Judge, we don't talk about the fact that sometimes the CEOs, Lisa Sue at AMD, now Intel has a great CEO. It is just a halcyon time. I've never seen all of them run by such competitive, good CEOs.
Yeah, a lot of the stocks reflect that leadership as well.
Yes.
And the kind that you speak about often. Steph, I find it interesting, right? We talk so often and we try to give advice to our this whole barbell. We've heard about it from you and others for so long. I'm wondering now, because we're thinking more about the reopening and the recovery, whether the barbell at this point has to have much more weight on one side than a more balanced way that it has up until this point. Can you speak to that at all? Does that make any sense?
Yeah, no, I do. I mean, I now 70% cyclicals and 30% long-term growth. And a lot of that is because of what I said earlier, that I think all of this is sloshing around and we're going to get more. We haven't even spent all of it yet. It takes a long time to get into the system. It takes almost a year to get into the system. So I think we're starting to see benefits. We're starting to see benefits. To Jim's point before, I've been talking about 10% GDP growth for weeks and quarters now because of all this pent-up demand. And so I think all this pent-up demand is going to be substantial and lead to better growth in earnings, and you want to have companies that have exposure to that. Economically sensitive companies where the margins have held up, but the revenues have come down, but they're so well run ad nauseum that they will see positive operating leverage as you see better demand on the top line. I think these companies, particularly in the industrials and the financial, have been doing a good job hanging in there until now, and I think this is their year. So we want to have more exposure on those companies, including industrials as well as also consumer discretionary. But I'm not giving up on Google, and in fact, I've been adding to that name. I'm not giving up on some of my tech companies. I happen to be more semiconductor-centric in terms of my holdings, but I think that there are definitely opportunities along the way. So you do want to have a balance, a little less of a balance.
You say you're not giving up on Google, rightfully so, because Google is very much a reopening story. If ever a FANG stock will be one. But, Jim, what do you think with the, to Steph's point about cyclicals and, industrial and discretionary, Boeing, American Airlines, and Delta United, all of the airlines which quarter-to-date have obviously had huge runs, and even month-to-date. And if we're talking about this, more weight going towards those types of airlines, continue to buy those?
Well, we're this guy, Philip Bowe. Okay, I think he knows these airlines better than the CEOs of the airlines. He's probably like the clearinghouse. I mean, if I was any question, I'd be calling and said, what's American doing? And he came on this morning and talked about raising rates. And by the way, not just total leverage. I mean, it's very rare that you have leverage for these airlines. So the answer is yes. And by the way, in this Boeing, people are saying to me, hey, shaking people realize that as long as I listen to Phil, I gotta own you gotta own the stock. Done. We have some about Palantir, which we just found out. Could you tell our viewers why you added rather significantly to your stake in Palantir?
Yes, they reported yesterday, and the stock was down on the report. It's interesting to listen to the CEO. He was speaking our language. He essentially said to investors, we are playing in a massive space here, and we're going to invest aggressively now in order to capitalize on the exponential changes that are taking place here. So if you are short-term in your focus, you probably don't want to spend too much time investing in Palantir. So that's music to our ears because, and we do believe more and more companies are going to start behaving in this way instead of catering to short-term time horizons and we would say, in some cases, short-sighted shareholders who are much more interested in profits now, dividends now, share repurchases now, than they are in a company investing aggressively for going short-term profitability in order to really to catch some very big waves out there. I'm astonished. Their revenues are still 61% government, but I've learned, and I think most people in the innovation space have learned over time, that some of the most important innovations in our lifetimes have started in the government, especially in the defense sector and in the intelligence sector. So we, in many ways, and they won't talk about how, but they're certainly garnering a lot of business, which tells us that they are seeing in the future and investing in the future in ways that companies, but increasingly companies are going to need, especially as we're competing against China. I think we've been, again, with a short-term time horizon, we have not been spending enough in innovation. And so, Palantir's attitude is refreshing. It's exactly how we invest. We want our companies to invest aggressively. We don't want profits now. We want them to invest aggressively because we're moving into many winner-take-most markets. And the autonomous taxi world is a very good example of that. That is why our confidence in Tesla, going back to the position in our portfolio, is so high.
I'm going to ask you about more stocks in just a moment. You spoke of a lot of the stocks in the flagship fund as having a longer runway than maybe some would suggest the pandemic would say. It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course. Now, one of the things that I found interesting over the last really 20 years is that the S&P's PE ratio tends to be in the 20 to 25 times range of the forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3. Now, if you think, and that's that's where long-term interest rates should stabilize. If you think of 20 to 25 times, that's 1 over 4 to 5% growth. So it's the inverse of the growth rate, the nominal GDP growth. And that's where it seemed to be peaking out. We think there's actually longer term, I agree with you, Scott, there will be a valuation reset, there will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names. But I think longer term, especially given the powerful growth trajectories that the 5 innovation platforms around which we revolve all of our research, that those trajectories are so powerful, that these multiples, these companies are going to grow into their multiples a lot faster than most investors are now expecting. And so that's a source of confidence for us.
Steve Weiss has a question for you, Kathy.
Hi,
Hey
Steve.
Kathy, good to see you again. So my question plays off what Scott just asked you. Do you take into account, or do you have any type of forecast in terms of things and adjust the portfolio to that forecast? Or do you keep cash? Those are kind of interesting in terms of the level of cash you have to keep or not keep. So rates right now, they're moving up. You say, okay, we may be a little trouble with the valuation reset. They're going to go up another whatever, up to, maybe. Do you get in front of it, or do you just take it as it comes?
No, we use it actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the coronavirus crisis presented, we will sell names which are creating losses now because, again, we've bought them, we've diversified bought them more recently. Sell those names creating losses to buy the highest conviction names. Some of the names we've been moving into are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do during we think of them as cash-like, but there's also an investment reason we are moving into them. Ironically, we think they're deep value names. These companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways to do things.
여태까지 보디빌더 중에 최고로 몸 좋았던 사람이 로니 컬먼이잖아요. 그분 고중량 고반복 했어요. 고중량 고반복, 오케이? 고중량 고반복. 모든 반복을 다 하세요. 1회에서 3회는 힘들기, 1회에서 6회라고 합시다. 8회에서 12회 근매수 증가, 12회 이상은 지구력. 고중량 고반복. 네. 고중량 고반복. 오케이? 고중량을 해서 힘을 늘리고 그 힘을 늘린 거로 중반복을 해서 근육을 늘리고 그 다음에 더 많은 반복을 해서 지구력을 늘리고 다 하세요. 다 하셔야 됩니다. 다. 고중량 고반복. 오케이? 고중량 고반복. 자, 고중량 고반복 하세요. 고중량 고반복. 네. 고중량 하면 좋은 게 120으로 했더니 70이 되게 가벼워졌어요. 네. 동원님, 다리 운동 열심히 해서 다리를 로니 콜먼처럼 만들으세요. 아셨죠? 네. TFCC 걱정하지 마시고 일단 다리를 로니 콜먼처럼 만들으세요. 내가 불편한 거에 초점을 맞추지 마시고 안 불편한 거부터 일단 잘하세요. 오케이? 다리를 로니 콜먼처럼. 자, 되게 가벼워졌어. 70이 120으로 했더니. 사람들이 고중량 고반복해서 막 70파운드로 한 몇 개 하는데 동원님 운동 너무 하고 싶으시면 다리 운동 열심히 하세요. 주 3회 하세요. 월수금으로 다리 완전 열심히 하세요. 다 했다. 저는 오늘 영어 영상을 영어랑 한국어 영상 그러면 제가 오늘 TFCC가 있으신 분은 제 영상 찾아보시고 손목이 아프신 분들이 손목에 물이 안 가고 할 수 있는 운동을 제가 찍어서 올려드릴게요. 아시죠? 손목이 아프신 분들이 손목에 무리가 안 가고 할 수 있는 운동을 제가 찍어서 올려드릴게요. 지금 찍겠습니다. 아셨죠? 야, 내가 불편한 거에 초점을 맞추지 마시고 내가 불편하지 않은 거에 대해서 내가 초점을 맞추세요. 내가 할 수 없는 거에 대해서 초점을 맞추시면 괴롭고 내가 할 수 있는 거에 초점을 맞추면 행복해요. 자, 여름에 겨울 생각하면 불행하고 겨울에 여름 생각하면 불행합니다. 제가 무슨 운동을 하면 좋은지 제가 찍어서 올려드릴게요. 아시죠? So thanks for watching today. I hope you guys have a great day, afternoon and evening. Don't forget to hit the like button. Please share with your friends and family, and then subscribe to my channel. Thank you. Have a great day. 여러분 감사합니다. 내일 뵙겠습니다.